podcast. I'm your host, Josh Appleman, the founder and CEO of Appleman Properties. On this episode, we will be talking with Nathan, who has started his real estate investing journey when he was 19 with his first rental property. Nathan has started to flip a lot of houses in order to fund his growth of his real estate portfolio. In 2021, Nathan launched his Divergent Capital company, a private equity fund, along with two other partners. Nathan and his team have successfully completed their first fund and are now opening their second fund of $25 million and will be purchasing between $55 and $75 million of assets under management. Nathan, we're excited to have you here today on the show. If you could just tell listeners a little bit more about yourself.
Yeah, hey, thanks for having me. You summed it up pretty good, but I started in single families and after about 4 years, I bought a duplex and kind of just kept upgrading, duplex, triplex, quad, and the same time kept flipping houses. That was like my income. Kind of got burnt out a little on the flipping houses, and I always wanted rentals anyway. So I kind of just ramped that up a bit more. And then fast forward to about 2 years ago, year and a half ago, I kind of formed this partnership with my two other partners. It's been great. We launched our first fund. We raised $5.5 million, bought I think like $16 million of apartment buildings, fully deployed that. It was 1 year from start to full deployment. And now we're launching our second fund, like you said, a $25 million raise. And we'll buy roughly $60 million of assets. That fund too will have a little bit more than just apartment buildings. Majority will be apartments, but we'll have some exposure to some triple net stuff and some opportunistic lending if it comes our way and makes sense.
Okay. All right. So you're getting into retail strip centers if possible.
If the deal has to make sense. So Everything we do is kind of value add. We like cash flow and adding, force and appreciation. In a couple of those industries, we have some strategic partners that will joint venture with, but just to give the fund a little diversification. And again, the deals have to come and they have to make sense.
Totally
open to a little more than just apartments.
Awesome. At what point, how many properties did you feel like, or did you have ownership of? And at what point did you feel like it's time to scale and time to make this thing bigger?
Yeah. So I probably flipped like about 100 houses and had like 53 rental units, and then I had a 23 unit under contract. And in reality, like, again, not that I had like I wasn't making like $10 million a year or anything crazy, but I had a good living, whatever. It just got really cumbersome adding like single family homes. They were almost like meaningless. Even duplexes, they just kind of, nothing really was moved the needle. So, like I said, started buying 6 units, 7 units. And basically then I ran to these two partners, which I wanted to partner with people earlier. It's just kind of hard to find, a good fit for where you're trying to go and have the alignment of vision. But that's kind of what happened. I hit a certain point where adding these units just became like tiresome and not fun because they were too small and they weren't exciting. It was very, boring almost. And it wasn't getting me to my goal of where I want to be so I needed a big change up. So then we got together, floated the idea of the fund and kind of hashed it out between the three of us. And then we sent it into legal and launched it. But that was the whole reason. All three of us wanted to push our portfolios larger and it allowed us basically to use our expertise a lot better. Because then there's three of us, so you're doing bigger stuff too. We're able to hire out some like menial tasks where before each of us was all like kind of on our own. If that makes sense.
Yeah, totally. When you can outsource, get rid of some of the lower, we'll say lower meaningful tasks, duties, obligations, and you can concentrate on the higher level stuff, and essentially just buy your own time back. Then you can accomplish a lot more. I totally agree with that. And it's great to hear your journey from one rental property all the way to where you're at now. So I like to ask, at what point did it just become where you wanted to scale bigger, faster, and finding partners with the same vision and mentality? That is hard to find those people, but once you do, it's unstoppable team.
Yeah, and so like it sounds goofy, but so even back when I was 19 and bought that single family house, I actually wanted to launch something like this fund but didn't have the money, was super young. Even buying those houses for the first couple of years, people kind of laugh at you and like, yeah, you're not going to get anything, none of your deals are going to make sense, that kind of stuff. So just in the back of my head, just kind of always thinking about basically doing this and moving towards this. And I probably had a couple of years would get a little sidetracked, probably could have got here a little quicker. You kind of get stuck in the like, oh, buy the flip, but yeah, so this is kind of where I've wanted to be. And then we're going to where we want to take it, which is we're hoping in the next 6 years we'll have $1 billion of assets under management.
Yeah, and that's certainly attainable. It's once you get that forward momentum, it happens quick. At what as far as like the process, you're purchasing single families, you're learning how it goes to title, the closing. I guess you have to start at some point, and starting at a house, where you can just learn the process and learn who's all involved and how the money works. That to me is one of the best ways to get it. At least you're in there and you're getting started.
Yeah, and the biggest thing for me was, like I said, I think I ended up saving around like $5,000. I worked at a car wash, and again, even that wasn't enough to buy a house, so it forced me to raise money. But the cool thing, it almost allowed me to like guarantee, like I found a house for $25,000. So I was able to tell the person that gave me the money, like, hey, it's $25,000, it's more than I have. But if everything goes terribly, right, you get the house plus, like I'll like 25,000 is not crazy, like I can work this job and here's $25,000. You could almost like guarantee it back, right? After a while, you can't do that anymore, but it was a small enough amount to earn the trust to be able to do that, and then build off that trust and buy more and more stuff and bring in more and more investors.
Yeah, start your track record. Cool.
Yeah, exactly.
So with the current state of the economy, what do you think multifamily is going to? How do you feel it is right now as a standpoint as a buyer, with the interest rates going up, the uncertainty with cap rates? Where do you feel like it's at?
Yeah. So the biggest thing right now from a buyer standpoint, like again, we're looking for deals constantly. Right now in the last couple months, comparing this to like last couple of years, buyers and sellers have a big disconnect. So like if you own a property, right, and you in your head you think it's worth $10 million, you're probably right up until the last couple of months, because the interest rates are so high. So your head's in kind of like last year's space. So if you're looking to sell, you want your 10 million. Me as a buyer, I underwrite it. If I gave you 10 million, my LTV is probably like 50%, because DSCR would be lower than any threshold because the interest rate went so high. So you're not really willing to accept that interest rates are lower, which I understand. I get it, because they rose so fast. Most sellers are like, okay, I want my 10 million, or I'm going to wait 3 months, and I think the interest rate's going to drop back down and normalize. So there's just a disconnect. And I think most of it is just because of how fast those interest rates rose. Where if they rose slowly over the last 4 years, everything would have gradually shifted. I do think that's going to start shifting and shaking loose in the next like 6 months. I mean, obviously, whether the interest rate's lower, that's an easier shift. And if they don't and just kind of stay stable or go up slowly, people are going to start realizing like, okay, I have to sell. I have this floating rate debt. I got to exit, or my loan's coming due in 1.5 years, and things just keep slightly going up. Again, I'm not forecasting whether the rate's going up or down, but any situation that happens, sellers will eventually come to reality.
Yeah. I think I think we're all really wanting the expectation to come back down to where it was just normalized, instead of the sellers expecting a purchase to be based on pro forma, a future rent, future value, more of how the property's currently performing, what is the current in place NOI, and how's that, because multifamily is a business. You're buying a business and what it cash flows. So you can't really, it's hard to buy a transactional business today. You just can't do it on a future would if value. And that's where multifamily was at, and still is for the most part. So it's, I know it's frustrating as buyers, and I can see where it's definitely frustrating as sellers, because they were seeing other people making the marks.
Yeah, and you were able to see so many deals happen with so many buyers that you get used to it. So, like I said, I don't think the mentality is fully shifted. But the good thing for buyers, I do think people are going to come back to like fundamentals and reality, and I think there's going to be some very good deals. but who knows? It could, who knows how long that's going to take.
I hear it. That's just like 2020 when the sky was falling, and then all of a sudden it came back strong and fierce. So I think 2023 is going to be pivotal. It could go either direction. I mean, we're still waiting for a black swan event, I guess.
Yeah. Exactly.
Going forward, do you think multifamily properties will still be as good as an investment as it has been in the past decade? And then as far as rent growth, cap rate compression, and other fundamentals that you'd typically see in these investments, what's your take on it?
Yeah. So I don't know if it'll be exactly as good as it was in the last decade, but to me, it's like the greatest investment in the world. It's real estate. Apartments specifically is like an asset in business that can't really be disrupted, or I can't foresee that, right? If you're even retail, the reason retail is a little scary is that can be disrupted. We've seen it happen. Office, we saw disruption. Apartments, everyone's got to live somewhere. So until something crazy happens, everyone needs a place to live. That's the biggest reason I like it. So demand will always be there. I mean, we saw demand got really crazy and out of hand. A lot of that was artificial because people weren't moving during COVID. Pent up stuff, and we're still short housing usage, so it's not all artificial, but over the next 10, 20 years, I still see apartment buildings as the greatest investment I know of, just because I know if I have a vacant unit, I have someone that needs to move into it. Yeah. And again, so as long as you're like underwriting deals conservatively, that you're always safe. Just like any investment, if you pay too much, right, you're going to run into trouble in anything you buy. But I just tend to think over time, apartments are a great investment, and one of the asset classes where time actually can heal stupidity.
That is fact.
Yeah,
for sure. You can still buy bad, and somehow time will bring it back to where you didn't do so bad.
Yeah, as long as you're capitalized to make it through.
Yeah, no, absolutely. And of course, multifamily being that everyone needs a house to stay, and I think it's more than just my opinion, but the future office space is widely recognized as being the house where people live at. With you've got the people that are doing hybrid workforces where they're coming into the office X amount of days or hours, and then they're working at their house. So that just it's another economic driver to multifamily of where people live is where they work.
Yeah,
and with demand.
Yeah, and I mean, and if that trend continues where people are using their house as offices, because they're able to lose that cost of an office, they're actually maybe able to afford a little more in rent. So I think that can also push prices up if people keep doing that. And again, that's all like extras. But the main point for me is you can't right now. I see no way for apartment buildings or even houses to get disrupted. People always want to rent. And the trend is actually going up on renting versus owning, and it has been for the last decade. So foreseeable future, I think it's a great investment.
Yeah, totally agree. So getting back to your fund, since you have fully deployed, and have been operating your fund, what do you see as the pros and cons of a fund structure versus a syndication? Syndication is a group investment. A fund is a pool of money, and then you go out and find the deals. What do you see as being the pros and cons?
So do you want, should I do this? I'll do this from an investor standpoint, like an investor in our fund. The biggest con is, right, we raise money and we kind of do it in tranches. So we don't just like tomorrow, we got 25 million bucks and it sits around. We kind of raise it as deals are coming in and stay a deal ahead. But even with doing that, there's still like dead money, right? So where like a syndication, it's like, okay, I have a $10 million deal under contract. We need 3 million to close it. Under contract. So now I raise my 3 million and deploy it. It's dead for 2 months, right? However long it takes to close. With a fund, like so, we raise a deal ahead, so we always have it. So we might have $1, $2, $3 million that isn't currently allocated for anything under contract. And if it takes us 1, 2, 3, 4 months to find a property, it's kind of dead money. That's honestly the biggest con and the only true con that I've ran into and that I believe is one. To offset though so talking about that con, like, yeah, it is a con, but what we tell our investors is like, you're basically giving us your money that otherwise is sitting in an account, not doing anything, right? And we're going to deploy it in a very strategic and smart way to hit our return thresholds. So like, yeah, it's dead, but if you didn't give it to us, it's sitting in your account kind of anyway. And it's not dead for that long. So in the meantime, there's a couple assets in the portfolio that are generating money. and you say you have another million or two, eventually that's going to get put somewhere. And at the same time that that's dead, we invest in our own fund pretty heavily. So our money's sitting right next to it. So all our money's dead at the same time. That's the con. The pros, in my opinion, heavily outweigh it, at least our investing style, right? One, if you only have 100,000 to invest, right? Like you say you invest in my fund, you give me 100,000. Well, that first fund of 5.5 million, we bought 16 million apartments. That was 8 apartment complexes, 250 units. Your 100 grand got put into multiple locations. You know, everyone knows an apartment building itself is slightly diversified because you might have 50 tenants versus one. Well, we have that, but then on top of that, you got 8 buildings. So if this business plan slows down, or maybe we're a little off, you have 7 more. The refi events can happen at different times. So it can be like, okay, here's like a 10K chunk. We refied. Oh, we sold this building. Here's 20 grand back. We do quarterly distribution. So you're receiving that. Just the pros of that end are huge. And then like the safety of, like, every property has its own reserve, right? You never want a capital call. We've never had one, even in previous things. But on top of never having one anyway, we treat each investment kind of like a syndication in the funds. So each one has its reserve. So the fact that that fund has 8 reserves, say we're wrong on one, something crazy happens, we can tap into this other one for the month. So we don't have to ask an investor anything. We have 8 separate reserve accounts all going at the same time. You just get this. It's great. You're very well capitalized to kind of withstand anything. Those are some benefits. And then there's other great benefits. I mean, we're an awesome buyer. Brokers love us. We part of that's us, right? We do what we say, we close on time, but we're also able to show that dead money. The biggest pro is we're able to say, hey, we have $2.5 million sitting in a bank account. Like, yeah, that guy, you know, he closes most of his deals, but he's a syndicator. He doesn't have it. The economy could turn. He can't pull his investors in. We have it. Here it is. And people love it, you know.
That's the biggest piece is what you just said is, say I've got a syndication and I'm coming in as a general partner for a syndication. You're operating the fund. The broker is definitely going to lean in your direction to win the property versus me, because he knows that you've got capital that is ready to be deployed. Right now, the closing isn't going to be, hopefully the raise is successful and we get to the closing table. You're already pre-closed in a sense.
Yeah, exactly. So like the surety just goes up X factor, even though, like I said before, you always close the deal anyway. Just in their head, they're like, okay, it's like a done deal, barring some crazy thing with the property. And there's a bunch of other benefits that we've seen, but those are some of the biggest ones.
And then as far as the dead money, I'm sure you all have it in a money market account or something that's generating something. That way it's not just sitting there, but it's just not producing the bigger returns that a property can produce for. And I would rather it be sitting in that debt account until you all could deploy it into a highly profitable property that we know is going to generate returns for years to come. So I would rather have patience on that than hurry up to get into a deal that may be a struggle and may not produce as well. So
exactly. And that's like our philosophy. We never will rush into a deal. We don't care. We even tell investors up front, we say, hey, the one maybe flaw is that you can say we have some dead money. And really it's not even an issue, but it's only an issue in the beginning, right? Like, you have one property and say you deployed 2 million and then you have 2 million sitting there. So half of your fund's equity is dead money. But as you go, 3rd, 4th, 5th, that percentage drops. So like after we had 4 properties in fund 1, we didn't raise the other 2.5 million anyway, right? We already deployed 2.5. We probably raised another 800 grand. So you have 800 grand, you already deployed 2.5 million. So you have 15% of the equities dead, but you also have a deal that's going to close in 3 months. Yeah. So as the fund moves, the percentages drop on what's considered dead money, and we're pretty good at deploying it. We're always trying to source deals. Even now, legal won't be done probably for another 2 weeks. We're working on a few deals right now that'll be for that fund, and obviously, if everything pencils and checks out, then those will go into it.
Love it, man. Love it. What are your investing goals, and where is your company going as a whole?
Yeah. So as a whole, and this is the best part about our partnership, because we're all in alignment, is we're shooting to have it, like I said, $1 billion under management in the next 5 years, which if you met me 2 years, like 2 years ago, not you, but most people would be, oh, that's crazy, right? Like your fund doesn't have anything. Well, the first fund, has 15 million. It'll probably be worth like 20-ish shortly, but the next one will have 60 to 70. So right there, you're almost at 100 million. Our third fund, whenever we get through fund two, we're shooting for $100 million, equity raise, which roughly $250 million, 250 million. Between those three funds, by that time, you'd be at $500 million. So you can see how you get there pretty quick, and most of it's systems, right? So actually, I think fund one was harder than what fund two is going to be, because we had to put all the systems in place, like the investor, like the software we use to handle our investors, all of that. It's all in place. So that took a lot of time, actually. So but that's our goal. So we're shooting for $1 billion asset under management in the next 5 years. And if it takes 7, 8, no problem. But that's where we're going. Just so we can offer our investors like a better product. So with that scale, we believe we can offer better diversification, better returns, a little better safety, and then also access to like a little bit better deals, like better quality deals, and have a couple different offerings sort of at the same time.
That's awesome. And then as you're growing, I mean, you're picking up steam too, because now your track record's getting bigger. Now you're attracting other people that may want to invest into your fund. So it's like your supply and demand keeps going up, and it just picks up incredible forward momentum. And then as a company, you're able to qualify for bigger deals because now your track record is bigger, and you can meet certain criteria out there.
And the financing kind of gets better. It actually gets easier as far as the loans. And I mean, momentum's huge. So I mean, and most real estate investors know, like me getting that first $25,000 house was super hard. It took me like 2 years, like 2 years to get a $25,000 house. After that house, I for 6 months I didn't look, but after that, I bought 4 houses in the next 10 months. And then the next year I probably bought 8. The momentum's great. So this fund, same thing. Like, it took us a year and a half from floating the idea to finishing the fund. Just everything moves quicker. Like fund one, we had to, go more out of our way. Fund's not even launched, and we have people reaching out to us who did not invest in fund one, and we didn't even talk to for fund one, and they want to invest in. And people we run into. So like brokers are calling us that we've never dealt with, and they're like, hey, like, see you doing stuff. And the momentum just you create this huge snowball, and it's got effects all over. So you just got to be able to capture it with a system and deal with it and handle it efficiently, and you can grow really, really fast.
Yeah, I love it. And that's that's kind of like getting yourself in the inner circle around the table with other people, is everyone pushes and motivates each other. And you build an accountability group where you find partners, and everyone's focused on different parts of the business, and it doesn't work unless it all works. Everyone comes together. So it's and like you said, it builds a snowball. It's huge. I love it. So the bonus question I have is, what advice could you give someone who's just starting out their journey in real estate investing?
So the best advice, and in my opinion, like I wish I would have just tried to find partners earlier. So like I said, when I was 19, I wanted to do the fund, but for 8 years, I never attempted to find like an actual partner of any sort. Like I might have like, I'm buying this house and throw in like a JV partner, one-off deal, but I never looked to have actual partners with the same vision until I was like 27. And, so, 8 or 9 years. But having a good partner, right? Having a bad partner is terrible. That can end bad, lawsuits, all kinds of stuff. But if you find the right partner, for me, the biggest thing is like full alignment in where you see yourself going. Because if you have that, you can figure out almost everything. If both people are in complete alignment with that. So to me, that was huge. That like supercharged everything, because now you have 3 people all with the same vision. So like even if you have like a down week yourself, you're like, oh man, this seems so hard. Well, then you talk to them and they're all fired up. So you get the same way. And then you just have 3 efforts and complementing talents. And even if you have similar, we have similar skill sets too, and we have different skill sets. The ones where we have similar ones, it just helps that so much more. And ones where I'm weak, and I can kind of say, hey, say for Travis, those are my partners. Like can you do that? And they do it. And they do the same thing, you know, to me. So
Yeah.
it just pushes us so much faster, and you're able to build such a bigger network, right? They each have their own network, and it just, again, you have like 3 snowballs going in the same direction. So that, to me, that's huge advice. I would just start doing that early. And you don't need to, when you're starting, right? If you're just buying single families, you don't really need a partner, but just start networking earlier with that intention, and don't rush it. So, you know, for 5 years, you might never pick a partner, but you might have met 50 people. And over time you say, hey, that guy, I've been, you know, bouncing ideas back and forth for 4 years, and he's, you know, just like me. And then maybe you test something out and go with it, you know?
Yeah, I know all of the hard money lenders. Everyone wants to see your experience. You know, what have you done? What have you done? And it's hard. The first deal is the toughest because you're limiting beliefs, getting over those, and then you're financing. Where's the money going to come from? And just connecting all the dots, putting the pieces together. So maybe even finding a joint venture partner out there that you could team up with, or someone to get more experience from. But then, you know, it goes back to education and making sure that you're confident coming to the table too, with just knowledge at hand.
Yes, that's a great point. So like, I mean, you can't just go out and like look for a partner and you're not an expert in what you're trying to do. Like you have to like do a lot of things, like, you know, like read books, go to stuff, like learn, network, like see what people are doing, then like attempt to do it. You can't just expect to find a partner if you're not bringing anything to the table. Like,
sure.
But yeah, so yeah, great point. So there's
Love
other
it,
things to do, but like the partnering, I think, is huge.
Nope, absolutely, man. For sure. Nathan, we truly appreciate you being on the show today. If you could, please let the listeners know how they can get a hold of you if they want to reach out.
Yeah. So the best way to reach me is just send me an email, Nathan, that's Nathan at divergentfund.com. Divergent Fund, no S at the end.com. But yeah, that's the easiest way to get a hold of me. I answer all of those.
Awesome. And then I'll put your contact information when we rebroadcast everything out. And truly a pleasure having you on here. We're excited to see where things go for you. I know you're already super successful, and your career is just getting started. So it's definitely exciting stuff.
No, yeah, thank you. And thanks for having me on. It was a lot of fun.
Awesome, Nathan. We'll talk soon. Appreciate you.
Yep. Thank you.
Thank you. Bye.